In this video, I'm going to be sharing with you 15 property investment mistakes that you need to avoid. We're going to be breaking them down into 3 categories: financing, purchasing, and strategy. Now, the truth is, I've made some of these mistakes myself, but hopefully unpacking these key points will help you avoid making these mistakes yourself in the future. Now, our first topic is around financing property. I'm going to start off with a very controversial first point, and that is most Australians are probably under borrowing what they should in terms of growing their property portfolio. A lot of Australians are risk averse. They're scared of taking on too much debt. This is going to be bad for them. They're going to be slave to the bank, a slave to their job. And that can be true if you buy the wrong property. But a lot of people are too scared to do anything. And that means they are under borrowing compared to people who are able to leverage and grow their asset base and buy the right properties, which balance out cash flow and capital growth. So under borrowing means that you might have excess capacity and you're not utilizing it. I can think of plenty of people I know in my personal life who aren't taking the steps to grow their asset base because they're scared. That's the truth. They're scared because they think taking on that debt means they're going to be tied to their mortgage forever. They want to pay down their family home. So let us pay down our family home and then we'll invest. The problem with that is the opportunity cost. If the market continues to grow, even at very conservative rates of 3, 4, 5% a year, that's compounded on a large value, a large dollar value of property. So if you've got $1 million property and it grows by 3, 4, 5% a year versus your friend who's got $3 million worth of property that grows 3, 4, 5% a year, the actual dollar value is far more significant because they have a leveraged asset base. So there's big opportunity cost if you focus on just paying down your own home rather than looking to grow your property portfolio. A second key financing point is not running your numbers when it comes to purchasing a property. People forget that you typically need to pay stamp duty out of excess cash that you've got. You need to be wary of actual maintenance on the property or strata or levies. There's lots of things that go into making a property purchase and breaking down the annual cash flows. So make sure you're not missing any of those secret costs when it comes to acquiring or holding your property investment. Now, point number 3 is showing enough money in your tax returns. Everyone wants to save on tax, don't we all? We don't want to pay too much to the government or more than we would have to. So why not maximize all our deductions and make sure we show as little income as possible? Well, the issue with that is you lack serviceability when you give that tax return to the bank. Your broker and your bank will go, well, you don't earn any money on paper, so how can I get you more money in terms of taking on more investment debt? So find a balance when you're making those tax claims. For our business owners, you're going to have generally more control between your income and all of the expenses you take on in a given year. So if you're going to go through an acquisition phase in your property portfolio, maybe that year you show less expenses and more income in your tax returns. And then in future years, of course, you might claim your tax returns once you've gone through an acquisition phase. For being a PAYG employee, have a chat with your boss, ask for a pay rise. Once you've gotten that pay rise, you can then go back to your broker or your bank and say, hey, I'm earning more money, see my most recent pay slips, and that will boost your serviceability as well. So whether you're a business owner or a PAYG employee, this is something to consider. Speaking of brokers and banks, you might be only having a chat with your main bank. Maybe it's CBA, maybe it's Westpac or one of the other big 4 banks. But we did this to begin with. We just dealt with CBA. As you build out your property portfolio, you might need to look at different banks and lenders, especially once you're hitting those serviceability caps. There are hundreds of financial lenders out here in Australia, not just the big 4 banks. So if you're getting stuck, have a chat with a couple of different brokers, look at a different panel of lenders, and open up your options. Of course, you need to balance the risk reward by taking on more debt if it's got a higher interest rate and some more risk, but it can be worth it in the right circumstances. For me, I like to balance our interest rates across all of our debt and consider the risk for a weighted average interest rate in my example. So look at those different lenders if you're getting capped out. Key issue number 5 when it comes to financing is not using good debt. A lot of people fail to recycle their bad debt into good debt. Bad debt is generally attached to your own home and it's not tax deductible. Whereas good debt is generally investment debt that you can claim a tax deduction for. Now, debt recycling allows you to pay down your bad debt and maximize your good debt. The way this is done is generally you want to pay down your owner-occupied residence as much as possible, and then you want to refinance out on a separate loan and use those funds to buy other investments. This will turn the bad debt attached to your own home into good debt because you're using those funds to acquire more assets. Take a look at some videos on debt recycling if you want to delve into that further, but it's a key strategy that you can use when it comes to financing and a mistake a lot of people make. Now we've gone through financing mistakes, it's time to move on to purchasing errors that property investors make. The first one is a doozy. It's buying with your emotions and not with logic. You need to make sure the numbers stack up, but it can't just be the numbers because you also need to look at the qualitative data and the future growth potential on an area and a property you're buying. So don't let your emotions take over, but don't just be number focused. Use both the quantitative and the qualitative data to make a decision. That's exactly what we do here at Purpose Property for our clients buying here in the Brisbane market. We look at both the quantitative and the qualitative data, run our numbers through a property calculator, and then make an assessment as to whether it's the right property for the right client. Big mistake number 2 is not doing your due diligence. This can mean building and pest inspections or detailed market analysis. You need to make sure you have covered this property. Have you run flood reports? Have you looked at the annual land valuation? Have you had a builder go through and assess what the shower looks like? What's the recess? Is there water coming through? Are there termites? There's so many questions that should be answered because making a property purchase is a massive decision. Now we have some expert building and pest inspectors that we work with here in Southeast Queensland, for example, and town planners if you're looking at doing a granny flat or a subdivision. So you can outsource these key areas of due diligence, but make sure you understand everything you need to about the property because I hate to find out you bought a property that was ridden with termites and you weren't aware, or buy a property that has a flood overlay, or you can't subdivide even though you thought you could. So get those checks and balances in place and don't be afraid to pay for the right advice in the right circumstances. Another issue I see is people overlooking future development and what's happening in terms of infrastructure. Now, using Southeast Queensland as an example, there's some major infrastructure happening here in the greater Brisbane market. We've got road upgrades, we've got busways, we've got trains, we've got schools that are being developed, we've got stadiums. There's a long list of future development upgrades that the local, state and federal governments are working on either together or separately depending on the circumstances, and you should be aware of how this affects your location. Adding amenity is one of the things that is critical to a property's success. If the property is well located with access to infrastructure, schools, access to the CBD, this is going to create more demand for that product if it's in the right location. And location does a lot of the heavy lifting. So be careful when you're selecting that property and buying in the right location for your price point. Another common mistake that I'm seeing become more and more popular with the rise of YouTube is chasing and timing the property market. Now, don't get me wrong, I think timing is important, both for yourself at an individual level and also timing the broader market and making sure you're making a sound investment decision. But what I am seeing a lot more of with the rise of these YouTube videos and news articles and property chats is people hotspot chasing. People chasing because someone else was chasing that area. But that might not be the right property or the right area for you, depending on what your goals and your journey looks like. So just be wary that you're not chasing the hype, you're not chasing hotspots. I'll continue to release videos to help people educate them around the Brisbane, the Logan, the Moreton Bay, the Redlands, the Ipswich City areas, but it doesn't mean you should be chasing a hotspot just because someone else is. Now we're at point number 10, so hold on with me because I hope you're not going through some buyer fatigue. Buyer fatigue can set in. I've seen it happen many a time where people, investors or owner occupiers, it's common in both circumstances, come and have a chat with me and go, Luke, we've been looking for 6, 12, 24 months and we still haven't found the right property for us. Whether it's your own home or an investment, buyer fatigue is real. If you're going to open homes every weekend, you're running this due diligence, you're doing the analysis, it can be a full-time gig. I mean, you're competing against us in our business at Purpose Property, and we're full-time buyers agents doing this every day of the week, which means it's going to take you time, skill, and resource to go out and find the right property for yourself. Now, don't get me wrong, I'm a big advocate of people doing this themselves if they want to. But just be aware that buyer fatigue may set in and you might not be as sharp as you were and you might take the wrong deal if you're not looking at that property through the right lens. So now we've covered off key mistakes in financing, key mistakes in purchasing. Our third and final topic is key mistakes when it comes to property strategy. A lot of people do not have a clear investment strategy. They are gone with the wind. They're going with the flow. They're trying to make decisions on the fly. They're buying here or buying there. Maybe they're buying townhouses, or maybe they're buying units, or now they're buying subdivisions. Their strategy is all over the shop. You need to have a clear vision of what you're looking to create in terms of dollar value and how you're going to get there. It doesn't have to be concrete. Your plans can change and move over time based on market feedback, based on your knowledge growing, but you do need to have a fairly clear strategy. My personal philosophy is to go for growth first and then to transition to more cash flow assets. And then maybe we go through another cycle of growth again and then buy some more cash flow assets. So growth and cash flow, growth and cash flow. The reason that works for us is because we wanted to grow our asset base. We wanted to get that compounding return, which is the eighth wonder in the world, or one of those wonders, where we're getting leveraged returns on those assets. We then wanted to balance out the cash flow. We didn't want too much stress in holding our property portfolio, as well as we want boosted serviceability with the brokers and banks. So make sure you have a clear investment strategy when it comes to growing and building your property portfolio. The second key strategic mistake I see a lot is failing to diversify. I've seen a lot of portfolios where they just buy in the Brisbane market. Now, I am a Brisbane buyer's agent and I am bullish on this market over the next 3, 5, 10 years, but that doesn't mean I want all of my properties here in Brisbane. You should diversify your asset base. One, from a risk profile, and two, there's some great land tax benefits in there. And a lot of people are running out of Melbourne at this point in time, or Victoria. So buying in multiple states can reduce your land tax bill and reduce your risk by buying in those multiple locations. Now, I do have a competitive advantage buying here in Southeast Queensland, so that might be why we want more weight of our assets in this state. But overall, we are looking to grow our asset base and balance it across multiple states to diversify properly. Another strategic mistake I see a lot is not having the right management team in place. A property manager is critical to ensuring the property does what it needs to do for you. It's being looked after, the tenant's being looked after, your rental income is being collected, and the maintenance is being done on the property. So put the right property manager in place. Things can and they do go wrong when it comes to property investing, but you can mitigate this by putting the right team members in place, and it can take time to find the right manager. This leads me into point number 4, which is neglecting maintenance on your property. A lot of investors are touted with being slumlords because they're not maintaining the home. They don't look after it. I think it's about a balance. You should look to maintain your property because it's in your own best interest, but also it looks after the tenants. Now, this can be dependent on your budget and your excess cash flows, but generally when Emily and I get a request for a light bulb replacement, or an oven needs to be replaced entirely, or something else like an aircon, we'll go ahead and do that straight away. Being on top of your maintenance means you can prevent things from snowballing and becoming a lot worse, keeps your tenants happy, and it's going to keep you happy in the long run too. We're at the finish line. Number 15 is having the right exit strategy. And if you want to see me break down in detail our personal exit strategies and my thoughts on that, then click this video over here. Thanks for sticking around to the end. I'll see you in the next one. Peace.